Hey, what's up guys? Welcome back to the channel. My name is Frank Mularcik, and in this video we're going to be discussing the differences between monthly and quarterly paying dividend stocks and trying to figure out if there's an advantage to investing in one over the other. And the way I'm going to be doing this is I'm going to be sort of simulating a specific stock and looking at the performance when it paid monthly, and then trying to simulate if maybe they paid quarterly, theoretically, what the performance would be in that case. And then I'm also going to be taking a look at some stocks that do pay quarterly and simulating them quarterly and monthly as well, sort of going the opposite way, just to look at a few stocks. Obviously, it's only going to be 4 companies or 4 stocks or ETFs, I guess. So it's not, a conclusive study on this subject, but it is over, like a 20-year period. So it should give us a pretty good idea of the true results, I guess. So basically in this spreadsheet, the 2 stocks we're looking at here is Realty Income O and Johnson & Johnson J&J. And so what I did is I just listed out all the dividends they paid since the beginning of 2000. So for Realty Income, they paid every month. So I listed it out every month. And then with Johnson & Johnson, they paid every quarter. So I listed out every quarter and left spaces in between for each month. And then what I did over here on this side is I sort of just added up the dividends. So for Realty Income, they paid these 3 months, January, February, and March. In the first quarter, they paid these 3 dividend amounts. So I just said, what if they paid on the first month of the quarter? And I just added up those 3 dividend amounts from that quarter to be their quarterly dividend amount. And so then I did that going down for each quarter. And then I did a similar thing with Johnson & Johnson, but just going the other way. So in this case, they paid, February, then May, then August, this dividend amount. And then I sort of divided that dividend amount by 3 and distributed it among the 3 months in each quarter. And I did that for all of the months going down here. And then basically what I did is I simulated investing in these companies. So for Realty Income, basically what you do is you list all the months and the price at that point and our starting number of shares. So we simulated $10,000 invested at the beginning of 2000. So that means the price at the beginning of 2000 was $10.05. So we started with 995 shares. And so we started with 995 shares, and because of that, they paid a certain amount of dividends, which is in the other spreadsheet per share, and we multiply that by the number of shares to get the amount of dividends paid. And then we are reinvesting those dividends, so we're going to drip a certain amount of shares, which is just the amount of dividends paid divided by the share price here. And then we're going to calculate our new number of shares, which is just the original number plus the shares dripped, and the market value is just that number of shares times the price on that date. Okay, so then we did that for all these months going down, and then I did a similar thing with each quarter and the simulated dividend payments each quarter that I had calculated in the previous sheet. And then here I just show the total returns basically. So at the top here, you can say the current value of our shares of Realty Income, if they paid quarterly, if they paid monthly, which they do, our current value would be $360,238. Whereas if we invested in them and they actually decided to pay quarterly at the beginning of 2000, then our current value would be $358,974. So barely just over $1,000 difference in that investment over 20 years is pretty insignificant if you think about it. And we did pretty much the same thing, same idea for Johnson & Johnson. So in the case where they paid quarterly, our current value is $66,605. And when they paid monthly, our current value is $66,696, which is less than $100 difference there. So just very close. And the monthly dividends sort of edged out by a tiny amount, but it's really essentially the same. And then we did a similar thing with Microsoft and VTI. So VTI is a index fund that pays quarterly. They're basically a total stock market index fund in the US. And that's one of my favorite index funds that I have a lot of my net worth in. So we listed out, again, all their dividends on the quarter and then simulated just dividing those quarterly dividends by 3 and putting them in each month. And Microsoft, they only started paying dividends in 2005, so we only have about 16 years of history there. but still quite a long time. And VTI we have since the beginning of, or the mid part of 2001, because I think before that, I forget, I actually made most of the spreadsheet a long time ago. Before this point, before the mid part of 2001, either they didn't pay dividends or their dividends weren't like consistently every quarter. So it was a little bit weird there. So I just kind of started there. It's still like 20 years of history, so it should do just as fine. So with Microsoft, the current value when they paid when they paid quarterly is $161,885, and when they paid monthly, it would be $162,067. So about $220 difference in that case, I think, or no, actually about $180 difference in that case. With the quarterly payments being just a tiny bit better. And then for VTI, their current value when paying quarterly and reinvesting all those dividends is $56,432. And when paying monthly, the current value is $56,272. So in this case, our investment would actually be worth a little bit less if we invested in VTI and they paid their dividends monthly. So that's very interesting. I'm really not exactly sure why that is. I would just guess that, the price of VTI on average is maybe a little bit lower near the ex-dividend date that we calculated our buys at, or our drips at, because then you would buy a little bit more shares when you do make those buys, and then your investment would be worth a little bit more money. And that's the one thing, kind of the one caveat here as to why these calculations aren't quite perfect, is that when I got these dividend values, what I did is I used a Python script to collect them from a data source and then just enter them in here. And the date that's listed is actually the ex-dividend date as opposed to the pay date. So this date for Microsoft, their first dividend, February 15th, 2005, they really would have paid sometime in March for that dividend rather than February. So the way that can make a difference is because I'm looking at the price at the specific date here and calculating the number of shares dripped based on that price. So if the price is higher, then you're going to drip less shares and you're going to have less shares in the future, which means your investment is going to be worth less. So that can make a little bit of a difference, but I figured over the long term, since we're looking at 16 to 21 years of data here, it's really not going to make too much of a difference, and so it probably won't matter all that much. So I also made a little summary page just to kind of summarize. So these are the 4 tickers of the companies we looked at, and if they all paid monthly, these are their values, and if they all paid quarterly, these are their values. And basically what we want to look at is the difference between these two numbers for each company. So for Realty Income, they were about $1,200 better when paying monthly, and then for Johnson & Johnson, about $90 better when paying monthly, Microsoft about $182 better when paying monthly, and VTI was about $160 worse when paying monthly. So those, to me, are pretty small numbers when you think about an investment that is over like 20 years. Those differences are pretty small, and obviously, if you invested $100,000 instead of $10,000, all these differences would be multiplied by 10. But still, if we look at the percentages, this is basically saying Realty Income was 0.35% better when paying monthly, and Johnson & Johnson was 0.14% better when paying monthly. So I think you get the idea there. And the basic point that I want to make in this video is that, as we saw from the data, it really doesn't make that much of a difference whether a company pays monthly or quarterly for the performance of your investment. Yes, in most cases, your investment is going to perform a little bit better if the company pays monthly versus quarterly. But the caveat is you can't look at one company like Johnson & Johnson and specifically choose whether you want them to pay monthly or quarterly. You have to just look at a company and accept whether they pay monthly or quarterly and invest in them. And it seems like to me that some people sort of are more attracted to some companies just because of the fact that they pay monthly, which is more often than quarterly. And that to me is frankly not a good investing decision at all, because as we can see, the compounding effect of monthly over quarterly is very small. And you should, when looking at a company, you should be more concerned about the fundamentals of their business. You should be more concerned about can their revenues and profits and cash flows, can those support the dividend, and are those numbers growing so that the dividend can grow as well? Does the company have a long track record of increasing their dividend, which shows us that they are going to be consistent and we can rely on them for that dividend? Because a lot of companies that pay monthly, in my opinion, from my experience, seem to be a little bit less fundamentally sound and a little bit less consistent, and oftentimes they just don't have as long or as consistent of a track record of paying dividends and increasing dividends. So that's just something I think people should be a little bit cautious about as to when looking at companies and whether they pay quarterly or monthly. I think you should just look at, obviously the dividend yield is important, the dividend growth rate is important, how long they've been increasing the dividend, the payout ratio, and those are some good dividend metrics to look at. And you can also look at fundamentals of their business, like revenues and profits and growth in those numbers, and free cash flows and how those numbers are growing as well. Those are all important things to look at. But in my eyes, using the number of times a year they pay a dividend as something that influences your investment decisions is just not a good idea at all. And I think that there's a lot of people who seem to think that that is a good idea, and I just don't think that's a good idea. So I tried to make this video to showcase the data and to show, the numbers don't lie. Technically, yes, you can argue that it's a little bit better when paying monthly, but it's really not that much better, in my opinion, that you should be looking at companies that pay monthly specifically because they pay monthly. So that's all I have for this video. I just want to thank you guys for sticking around to the end. I really do appreciate that, and I will see you in the next one.